Hi folks, this is Bang here. Now I want to show you how to use a protective put strategy to protect your portfolio or to hedge your portfolio against the market crash. So the intent of owning a portfolio of stocks is to expect your stock price to go up either for your long-term capital gain or dividend that you can collect along the way, and often people use it for their retirement account or even their long-term investment account. So let's say I'm holding on to a portfolio of stock like this, which I have so many positions, right? So you can see that I'm having various types of stocks across different sectors, and most of them are very fundamentally good company, and I'm holding on to it with the intent to get the benefit on the long run. However, recently, if you look at the whole market as represented by SPX, which is S&P 500 index, and if you look at the ETF of S&P 500, recently it has run up quite a bit, and it seems to face a very strong resistance level at around 272, 73, which at the same time being both the midterm moving average with 150 and the long-term moving average, which is 200 moving average line, right? So it looked like it failed to break through that line, and it could be that now the market is on the short-term downtrend again. So I'm just concerned that because the whole market going to be corrected in the short term, it's going to affect my portfolio, and hence I'm thinking of buying some insurance for my stocks or my stock portfolio for that matter. So normally if you want to protect your stock, you can do either individually, meaning you can buy a put option for each of the stocks that you are holding here, right? For example, 100 shares of Disney, then you have to buy one put contract on Disney, right? And then 100 share on Facebook, you do the same thing, one put contract on Facebook. 200 share on Qualcomm, then you have to buy two contracts on Qualcomm put, for example. But that will be a very tedious exercise. And then you really don't know if the market move one way, each of your stock will move in different ways, right? Some of the stock will move exactly like the market, some of them move a fraction of the market magnitude, or some of them move more than the market, right? So you just don't know. And then Adam already mentioned to you how to use beta to weight your portfolio, right? So you can find beta in website like Finviz, but in fact in Thinkorswim you can also find the data, right? So basically, for example, if you want to find the beta on a stock like Facebook, right, just type Facebook here, right, and under the underlying, just click into this arrow to open it up, and right here you can see the beta. So 0.86, meaning if the market move down by 1%, Facebook will tend to move only 0.86%. So it moved less than the market. For stock like Qualcomm, for example, right? Qualcomm, you type it in. Again, you can see the beta data right here. So 1.24, meaning if SPX or SPY drop by 1%, Qualcomm tend to drop more than that, about 1.24%. So you can do the beta weighting, meaning you factor in the total capital that you invested in each of the stock, time the beta, and then you come up with the total equivalent SPX or SPY shares that you need to buy to protect. But that would be a very long exercise. In fact, Thinkorswim allows you to do the same exercise by one shot, right? You just go to the position statement here and tick the beta weighting, right? And here they allows you to beta weight against any stocks or any index that you want. In this case, I beta weight versus SPY, which is the whole S&P 500 ETF, just represent the whole market, right? So if I do that, I just type beta weighting and then SPY, and I enter. Here all the position has been beta weighted towards the SPY. So before you click into beta weighting, you see the delta column here. The total portfolio delta right now is 1719 or 1721, right? 1720 something, right? What does it mean? It means that if each of my share goes up by $1 per share, how much is it going to affect my profit? For example, Disney share price go up by $1. I will get $100 profit because I own 100 shares, right? So $1 up in share price, I got $100 profit. On the other ways, if it dropped by $1, I lose $100, right? Same thing, if Facebook goes up by $1 per share, I make $100 profit extra. So each of those represent the profit or loss if the underlying share price go up or down by $1. So let's say, just hypothetical scenario here, each of my stocks in my portfolio goes up by $1 per share for each of them. My portfolio will generate $1,724 extra profit. Okay, so that's what it means. And if it dropped by $1 each of them, my portfolio will be hurt by 1,723 right now, right? So, but then you really don't know when the market move up or down or fluctuate. Each of the stock will move in different way, right? Some of them move more, some of them move less, or some of them even move opposite direction. Then you need to kind of beta weight against the market to see what would likely a scenario if the SPX go up or down by 1, right? Or SPY for that matter. So then you beta weight it, right? Beta, click on the beta weight and choose the SPY as the weight that you want to compare each of your stock against. So if you click on it, all your delta or your stock will be now converted into equivalent number of SPY shares. What does it mean here? Now the total delta is down to 556 or 557, meaning if SPY goes up by $1 per share, my total portfolio would likely generate extra $557. And the reverse is true. If it dropped by $1, my portfolio is likely to be losing by $557. So that is the beta weighting. So then, if you want to hedge your portfolio against the market, right? Then you have to sell short 557 shares of SPY to be balanced, right? So now if you add one short position into your portfolio, and that short position has 557 shares of SPY, guess what? If SPY drop $1, you will be hurt by 557 here, but you make 557 from your short shares. So it neutralizes. So that's the way you hedge your portfolio of stocks. So in this case, you can choose to short sell 557 share of SPY, but that would be very costly because that requires you to have a huge capital in your account. You can use put options to do the same intent, right? So 557 is almost similar to 5 contracts divided by 100. So you have about 5 or 6 contracts of SPY. That is the number of contracts you want to buy on the put option so that you can protect your portfolio. Now, you learn from the theory part that when you buy a put on SPY, you would rather choose the slightly in the money or at the money put option, which means you will buy at the delta of 50 or 60, right? 0.5 or 0.6. Now, remember, if you buy an option with the delta of 0.5, what does it mean? That means if the underlying shares, which is SPY in this case, move by $1, your option value will move half of the dollars. Here you want to protect your portfolio up to this amount, right? If you buy 5 or 6 contracts and at the delta of 50, guess what? If the SPY drop by $1, your put option value will increase by half of this, half of the 556. So therefore, if you want to completely hedge your portfolio, you would likely have to increase number of your contract to like double, like let's say 10 contract. And then at 10 contract and delta of 50, then if the stock price drop by $1, that will translate into about $550 of the profit on the options, which offset against $556 that you're supposed to lose here. Got it? So with that in mind, right, now you can plan it out and then execute. So we know that we want to protect the entire portfolio, which is 556 here, let's say 5 contract. And because you want to buy a delta of 50, so you have to increase the number of contract by 2 to 10 contract. So you need to buy 10 contract of SPY to protect the entire your portfolio. Okay. Now there are 2 ways. Either you buy 10 contract on SPY put, or you can buy 1 contract on SPX put, because SPX is 10 times of SPY, right? So let's make it simple. I do 10 contract on SPY, right? So let's see. So go here, and I want to protect my portfolio, let's say in the next 30-40 days, because I believe in the long term SPY will continue to go up, even go up beyond the 275 here, so it will become an uptrend again, right? But in the short term it may go down. It may go down because in the next 30-40 days many things can happen, right? We know the US and China trade negotiations still going on, and we just don't know what is going to come out from the negotiation. If it breaks down, stock market can crash, and then now you have the insurance to protect it. If the outcome is a positive one, guess what? The market will go up, and then on your portfolio will go up with that, right? Supposedly. And your put option will just become your insurance policy, which means that's good money you spend to protect your portfolio. So I just want to protect in the next maybe 40 days. And again, the rule of thumb is if you want to protect 40 days, you just add another 30 days to make sure that by the time you exit, you still have at least 30 days left in your option, so that it won't expire worthless, right? It still has some extrinsic value there, so that you can sell that put option for some remaining value. So with that, I will choose the DTE, which is the date to expiration of around 70 days or so. Okay, so I go to the trade, and SPY, I found an option series expiring in 69 days. Not perfect, 70, that's fine, 69 is fine, expiring on April 18. So click onto it, and as I said, I prefer to buy at the money or slightly in the money, which has a delta of 50. So if I buy delta of 50, now the market is at 268, and 268 is about 50 right here. So I buy 10 contract, right? So I click into the ask price, and I just increase the number of contract to 10. And if I want to bargain, I can go down a little bit, and I click send. Okay, so my max loss will be what? Because I'm paying $724 per contract, which is $724, then 10 contract cost me $7,240, which is quite a lot. Again, my plan is to protect my portfolio, and I don't plan to lose 100% of the premium. So if I have to cut loss at half of this amount, I will do, because my portfolio is quite big. It's decent. So the cost of insurance of $7,000 may be worth it, because otherwise I could lose a lot more than this insurance premium. So if I'm happy with that, right, I just send it out. Then it's filled. Now it's go to the monitor, and you see my SPY option is in here, 10 contract. Now the 100 share I bought on the SPY is still there. That's a separate one. But the one I just entered is this one, right? Which is today, 9th of February, right? I which just enter. So that 10 contract. And you look at 10 contract here, it helped me protect up to almost $500. You see, now the delta with the protection here, the total delta from my portfolio is almost zero. Very neutral right now. Because I bought 10 contract, I could have bought like 11 contract to make it completely zero. But that's fine, right? So it used to be 557, now it's down to 62. Meaning if the SPY dropped by $1, I would lose only $62 instead of 557. Remember, that's the intent, right? So you want to make sure that in the short term, you are protected. But again, if it continue to go up, your option will lose value, but entire portfolio is supposed to go up in value as well. So that's the way you enter a protective put to hedge your portfolio of stocks. And again, if you hold a portfolio of options, you can do the same thing. Just do the beta weighting and calculate how many contracts of SPY you need to buy the put on so that you can hedge against the downturn. With that, I hope it give you an idea on how to use the option to hedge your portfolio.